All right, we're back for another episode of the Mortgage Show. First episode of 2025. Beds, how are you doing?
Just got up from a nap, kid. Ready to go.
Full disclosure, we're recording this 10 minutes late. Beds was nowhere to be found. I'm just sitting here waiting, and I had to text him and ask him if he was napping because that is a common occurrence in the office. So I just want to double check. He was not, but we made it online.
I mean, we should disclose that I do nap on occasion.
Hey, you're a mid-40-year-old man. It's very normal.
I don't even know what to say to that. When I hear I'm a mid-40-year-old man, my brain is functioning at like 27 max.
I mean, almost late 40s at this point, so.
Dude, stop. I don't know what to say. I'm getting older.
But hey, here we are, 2025, ready to kick off the year. Got a whole bunch of things to talk about for our referral partners, customers, anyone that's listening. I want to share some mortgage news, some tips, and kind of go from there. So before we do that, though, Beds, I want to get your thoughts on something not mortgage related. One more time before we get into that stuff. Our boy Mike Vrabel just got hired by the New England Patriots yesterday. What are your thoughts?
So we're big New England Patriots guys, you and I. So this is exciting news for us, man, because like football for me on Sundays was like church to other people, and it's been very weird not having that scenario on Sundays. I mean, I still was watching, but it's really weird to watch your favorite team get its tail kicked, and after all these years, I feel like I have an opinion on coaching.
Yeah.
Don't you?
You hear my dog in the background?
Yeah, but I'm fighting through it, man.
She loves barking when we're doing podcasts. So,
well, I mean, she's agreeing with us that Vrabel needed to come in. And to our listeners, the great Randy Forcier called this over a year ago now.
I did. I feel pretty good about that. It seemed like the move we should have made. Vrabel was there on the table for us to take. And for whatever reason, Robert Kraft agreed that Mayo was going to be the coach years in advance. And unfortunately, it didn't work out for him. But thankfully, Vrabel was still available a year later. And here we are. I actually just watched a half-hour interview with him on, I think, 98.5. They also posted on YouTube, and it was awesome. He's the man. He's going to crush it in New England.
I like that it appears that he has the final decision-making, too, in the front office. So they're keeping Elliott Wolf. They're bringing over a guy that he has from the New York Giants. I want Vrabel doing everything.
Yeah. He's awesome.
Yeah.
He spoke really well, said all the right things. We needed a guy like him. So I'm pumped about it. Big news for us past couple days. I'm fired up about the Pats again.
Yes, same.
Want to get into some mortgage stuff?
Let's hammer, man. Where are we going to start?
I think we should start with the thing that people often talk to us about. I kind of feel like a broken record on interest rates, but it's important to say that interest rates continue to work against us. Friday, there was a hot jobless report, meaning that there was more jobs added to the economy than expected, which seems to happen a lot lately. And that sent rates kind of into a tailspin upwards. So we're fighting through that right now. Do you have any info on that you want to share?
I'm just confused by it all because a couple of weeks ago we read a sort of very quiet report of a revision of the prior jobs numbers, which suggested that the numbers were negative for jobs created. So then we have this jobs report that passed Friday, and of course it's HUD again. So it's like I'm in this headspace of like, what's the number right now? Give it to us. Stop revision. You know, the revisions are killing us.
Yeah, I mean, the revisions paint a picture of a not as strong economy, but the bond and interest rate environment doesn't seem to react to those revisions. They just react to the initial reports. And it's almost like it doesn't matter what happens with the revisions afterwards. And that's exactly what happened. And the reason that it's big news on Friday was because it increased the chatter of, hey, the Federal Reserve might not cut rates the 2 times that they said they were going to in 2025. Because it was actually like earlier at the end of 2024, it was like Fed's going to cut rates 4 times in 2025. Some hot economic news came in. They used language along the lines of we're only going to cut rates maybe 2 times in 2025. And then this jobs report comes out and it's like, is the Fed even going to cut rates in 2025? Are they going to have to raise rates in 2025? And the market's just been kind of a mess since then. It's just unfortunate.
I guess as a reminder, good economic news is bad for us.
Yeah.
And I guess we continue to have good economic news. It's just, like I said, these revisions sort of contradict a few weeks later, but the bonds don't respond to it. So here we are.
Yeah. So I think experts still predict rates in the low sixes by the end of 2025, but that's a long ways from now. So anyone that's listening to this is buying in the first half of the year, you might be staring at a crooked number for most of that first half of the year, unless something changes in the economy and we start getting really bad jobs reports, or we get inflation readings that are really below the target, or there's some type of language where the Fed says that they are going to cut rates more than the 2 times that I think the market anticipates right now. Outside of that, we're probably looking at sevens for a bit.
What's interesting too is like globally, we got some stuff going on in California. There's always this like thought that there might be a war. It's like we've been fighting through like all of this stuff that normally helps interest rates come down. So here we are, crooked number, like you said.
Yep. So sevens, always happy to talk about that stuff. Anyone listening can always check in. We can give you an honest assessment of what interest rates are. Remember that rates vary based on the type of loan that you're doing, the type of down payment the borrower has, the credit score that they have, the occupancy of the property. So, make sure you check in with us about rates. Every situation is a little bit different. We're happy to price things out, but in general, rates are around 7 plus or minus.
Yep.
So, all right, Beds. Next thing I want to talk about, something that we talked about in episodes in the past, and that's about a unique program for first-time home buyers, typically first-time home buyers. You don't necessarily have to be a first-time home buyer, but it's the Maine State Housing loan. And the reason I bring it up is because Maine State Housing a couple weeks ago announced that CMG was the #1 Maine State Housing lender in Maine, which I thought was pretty exciting, something to be proud of. So we're doing a lot of these over here.
We have quite a presence too. There's a lot of us up here, and there's a lot of us doing the loans. It's an awesome loan. Down payment assisting, right?
Yep.
Different branches of that.
So I just want to set the stage for what a Maine State Housing loan is for people that might be listening, for referral partners. Maine State Housing is just it's a government type loan that can be piggybacked on top of loans that you may have heard of before, FHA loans, rural development loans, VA loans. If it's your first home, you can get a credit of $5,000 towards your closing costs. Interest rates are 5.375 right now, fixed for 30 years. If you're a veteran, it's 0.5% below that. So in that case, 4.875. If it's the first, there's also an aspect of it being your first generation homeowner, meaning you did not grow up in a home. You grew up renting. No one in your family had owned a home before. A lot of new Americans use that type of aspect of this loan, and that would give you a $10,000 credit towards your closing costs, and the rate actually is a further 0.5% less at 4.375. So rates were higher than this most of last year, but in September, when interest rates dipped for a second, Maine State Housing dipped as well, and they still happen to be at that range where everything else has risen back up into the sevens like we were just talking about. So if you're a first-time home buyer, you're under the income limits, the geography of where you're buying makes sense, Maine State Housing is a great option for you for many reasons. And like I said, CMG does a ton of them. #1.
Pretty nice. It's pretty nice where it's like if you're qualifying for an RD loan, you get that $5,000 credit. The thing is, it's like you always need to make sure that the borrower is putting 1% of their own funds into the transaction. So if we're taking advantage of a government no money down loan, that $5,000 credit's nice towards the closing costs, and then you fill the gap from the 1% of the borrower's funds. So I have an FHA one going right now where they're first gen. We have a seller paid closing cost credit. We have $10K for the first gen, and we're using 1% of the borrower's funds to fill the gap. So it's really nice.
Yeah. And the home inspection counts for that stuff, and you can make that work. So that is good to point out, though.
So those are pretty nice. Those are really nice. Those are really nice options. And I think, you and I have talked about the market shifting a little bit, where sellers are starting to accept alternative sources of financing. I guess if you're a listing agent or you're an agent listing a lot of property, don't hesitate to use these. They're really nice for buyers. Maybe it's a government loan, so you're paying attention to the HUD minimum standards. So some physical condition stuff that you want to be cognizant about. But if you have a really nice listing, you have a MSHA buyer coming in, accept it.
Yeah. It's not something to shy away from just because of what you just mentioned. I mean, a lot of times if there's peeling paint, which tends to be the biggest thing, and we've talked about on the podcast before, we can do escrow holdbacks for stuff like that. Don't hold your concerns about that against these buyers that are well-qualified, buyers that should be using these programs that the government provides, because we can find ways to make it work.
And and when we say well qualified buyers, so there's assistance there, which is nice, but on the mortgage side of things with the debt to income ratio, it's a very conservative loan. So a buyer coming in that does have this approval has been vetted and is sort of not maxing that budget. So in
Yeah.
theory, a very qualified buyer.
Yeah. Much more conservative debt to income ratios than even what you see in some conventional loans and especially regular FHA minus the Maine State Housing aspect. So yeah, it's good to point that out as well. So
Thank you, Randy.
yeah. Yeah, really nice job, Chris.
Thank you very much, buddy.
It sounds like I really touched you on that, so I'm glad that really had an impact on you.
I was going to make some wise ass beard comment, but I guess I'll keep it to myself. I'm jealous of that
Next
beard.
podcast. I did want to point out that the number two lender for Maine State Housing in Maine was Bangor Savings, and it's amazing they did that with the lack of loan officers that they have over there. So
Does Brian even show up to work?
love you, Brad. Miss you, Brad. Nice job, Bangor. But so keep that in mind as well.
You need to do that for the preview.
He'll love that. The next thing I want to talk about kind of borders on what you were talking about, worrying about HUD minimum standards and conditions of properties. A lot of times, at least I get this question a lot.
Yeah.
Buyers are looking at properties that have a detached garage or shed, and it's typically dilapidated or falling apart because why wouldn't it be? If, God forbid it be in good shape and make things easy. But a lot of times the agent would be like, they have this shed that's in awful shape. Like, how is that going to impact the transaction if the house is perfectly fine? And it kind of goes along the lines of what we were just talking about. But the biggest issue for places like that, or just houses in general, are if there are health and safety issues, meaning that there's mold or the foundation's crumbling or the place is on the verge of falling apart. If this detached garage or shed does not fit into that category, and it may, but if it doesn't, and it's just an in poor condition structure, we can disregard the value of that. And it probably doesn't really have any value and still move forward with appraising the home without that structure on the land. So I think it's important to note for people because this comes up all the time lately.
What if that garage? It's funny. I saw one today with a tarp on the roof. It looked like the pitch of the roof was caving in. It's so you can disregard that in most cases because you're not adding value. But what if that's a physical, like, what if that's a physical issue that might create a hazard scenario for a new buyer coming in? So that's where you get in this area of like, when we're asked this question, Chris, Randy, what's up with this garage? Do you think it's going to be an issue? At the end of the day, Chris and Randy don't know because we're not the appraiser. The appraiser's job is to comment on physical condition of properties, exterior structures, garages, sheds, pools, whatever it is. You can get away with the value part of it, but it's like, what if it is an issue where it's like, if they shouldn't be around it, the new homeowners, it's probably going to be an issue, but at the end of the day, it's appraiser discretion. So how do we know? We don't.
Yeah, it's important to note that you can have a structure that is in poor condition that doesn't have any health and safety issues and be fine. But you could also have ones that do have health and safety issues. And again, the appraiser is the person to make that determination. So I feel like the conversation always ends the same way, that it just depends on the appraiser. And I hate to just like put it off on that, but that's the truth. I've had deals where we've made our face turn blue being worried about a situation, and then we get an appraisal come in and they don't even make a mention of it. Or other ones that we don't even talk about an issue, and then the appraisal makes an issue of it. And it's just like, I don't know that it makes sense to worry about it, but if this is the house for them, minus like whatever's going on with this structure, let's just get this thing under contract, order the appraisal, and see what happens.
Another scenario, I talked to you about this morning. I had a pool that was removed in the electrical, which, came up through a conduit, which was on a piece of pressure treated, which was usually vertical against a pump scenario. Everything's gone, so they just let that electrical piece just fall on the ground.
Yeah.
So that came up as it was a health issue, a hazard issue. So what happened with that one is the electrician needed to come over and basically disconnect it. So that was other side of the conduit, pull it through, put the dirt on the hole. Thanks for coming.
That's an easy fix though, but definitely a health issue, safety issue as it stood before. And a
Yep.
lot of times there are fixes. I mean, sometimes the fixes are bigger than others, but that's an easy one, So
It's interesting, Randy, where I want to say this because at the end of the day, you and I are going to get the question because there's an anxiety level with the real estate agents as they're working through transactions and sort of projecting things to sellers and buyers, and like there's a lot of stuff that goes on there. We love the question. At the end of the day, we have the same anxiety. We don't know.
yeah, yeah. So definitely keep the questions coming. But that's just a little insight to some of the deals that we've been dealing with lately and the conversations that we've been having. Other topic that we talk a lot about with people is just credit
Yeah.
stuff. So I don't know that we've gone over some general credit tips on the podcast. So want to spend a few minutes on giving some tips to buyers, to realtors to share with their buyers, to anyone that's listening. What are some credit tips you're giving people in 2025?
Let's start with if you have an existing account and then you see the new shiny account that has all the points, rewards, and stuff. So, more specifically, you have a credit profile, you have a couple of credit cards that have 5 years of history. You see that there are two new credit cards that will give you X amount of points if you transfer balances and close out an old account. Here's the thing with that. It's nice to get the points, it's nice to get the new interest rate, the new payment, and all of that stuff, but you're going to get a mortgage. What does it do to your credit scores? What you need to focus on. And if you close those accounts with 5 years of history, you eliminated 5 years of history. That's no longer there. It's gone. And then you start saying, well, but Chris, I had 5 years of history. But the answer is it's now gone. So it's
Yeah.
not like it's not there anymore. So it's not weighted anymore in the credit score. So I have this former neighbor who actually closed out 30 years of history of a couple of accounts that he had, and it was just because she thought they were old, blah blah blah. But he was a 700 credit score borrower when I did their purchase. I went to refinance them, and he was a 640, and it was just because she closed all of his old accounts that had 30 years of history. So that's something to avoid. So that's one piece. What do you got?
Yeah. Just to piggyback on that for 1 second, if you want to make the transfer to get the 0% interest rate or get some points, do that. If that's something you want to do and you think it makes sense, just don't close out the other account. Just keep it open with a zero balance. The history won't go anywhere. You'll build up history on a new account, but it's the closing out of accounts that kills you. And you see it to some degree when you pay off cars and things like that too, because the history can disappear on those accounts when they become closed. Not a whole lot you can do in that situation, but when it comes to revolving debt like credit cards, like just keep them open, even if you're going to pay the balance down to zero and start using another credit card or transfer a balance or something like that.
As we go further into this, we should say that we're not credit people. We're just giving advice. Randy and I have sat in this chair forever watching credit move, sat in on seminars. We've seen all these videos. Another piece of what we're talking about is if you do start that new piece of credit, you're not going to get positive utilization until 6 months. So it's almost like a courting period in credit. You have to go 5 months of paying things on time, keeping your balances low, and then on the 6th month, that new card is going to start generating positive scores. So good move to get those points. Don't close the old ones. Don't expect the new score to come up right away.
Yeah. The way to impact your credit in the short term, the easiest is when it comes to revolving accounts like credit cards and paying down balances relative to what the limits are. So a lot of times people come in and they have bad credit. It's like, how do I improve my credit right away? If you have a maxed out credit card, the best thing you can do is pay that down to a certain percentage. And then next time the account reports, you'll see a bump in your credit in the short term. I typically tell people 20%. I think I've been overdoing it. Beds, you said it's 33% of the limit is where you want your balance to be below.
Yep.
That's typically what you're telling them, right?
So $100, if you have a card that has $100, if you carry over an on-time balance of $33 and below, that's generating the best case score. 33 to 50 is you're sort of in the perfect, if that makes sense. From 50 to 75, now your scores are starting to go down. 75 and above, you're just punching your scores in the mouth. The theory behind that is, and I'm going to piggyback this with a most recent late. I was at a credit seminar once where this guy was very, very awesome. I mean, super articulate. He had the control of the room. And then he all of a sudden started screaming. And he like startled all of us. And he used that to sort of teach us, if you have a most recent late or if you're overextending your credit, that's sort of how the credit agencies look at you. They start screaming, oh my God, these guys are overextending. They're having issues with their credit. So now we're going to punch the scores in the mouth so they can't turn around and get more credit and mistreat that credit. So don't
That
be
makes a ton of sense. I like that.
dude, don't be late and keep your balances down.
The late aspect, it has a huge impact. I have seen deals fall apart over $40 missed Kohl's payments. Or you said Target when we were talking earlier. It happens. You think you're on auto pay, or you just lose track of a bill, and the next thing you know, you're 30 days late on a very small credit card balance. That's enough to drop your credit score 100 points, and could easily be the difference between you qualifying and not qualifying, or at the very least, be the difference between one rate and a significantly higher rate costing you thousands and thousands of dollars. So can't say it enough. Like, make sure your payments are on time. Like, it's a personal thing on how you manage your credit card payments and all your payments, but just know that even a $25 late payment, there's really no excuse that can be used to fix that on a credit report once it's there. Like, I've never seen it. I've had a million people tell me whatever excuse they want as to why that late happened, but there is no getting that off your credit score once it's there. The creditor might waive whatever late fees they have, but like, if you miss a payment, it's because you missed a payment, and your credit score is going to reflect it.
Belichick philosophy here. It is what it is.
Yeah. So, but yeah, we're always happy to generally talk about credit. It's a big part of getting a mortgage. It drives people's ability to qualify. It drives their interest rates. So naturally, we're having these conversations with people. Again, there's things that we can do in the short term for people that we talk to that want to buy a house in the next 1 to 3 months, and they have the right credit profile. For other people, it might be something more long term, something like opening a secured credit card. We talked a little bit about this, Beds, before, but how does one build credit when they don't have credit and their credit score is not great? One way to do that is a secured credit card. Do you want to get into what that's all about?
I do. Secured credit card is basically providing a deposit. And typically it's credit unions around here that offer these. Is basically you give them $500. They give you a credit card. It acts as a debit card, and you're drawing from your own money, but you need to repay your own money. And again, the same philosophy is you have to have it for 5 months, pay it on time, and then once that 6-month hits, now you're getting positive utilization. Now you're generating credit scores. That's one way to do it if you don't have a cosigner.
Yeah, absolutely. I talk to a lot of people who don't have any credit or really bad credit, and that's something they need to do. And honestly, most of the people don't actually do it. When you give that advice, like go to the bank, go to your credit union, open up a secured credit card, start building credit, because you're going to want to buy a house at some point. Just because we have a conversation and your credit's not where it needs to be, and we unfortunately have to tell you that news, like, if we're telling you to get a secured credit card, again, you're not going to be able to buy it the next day, but like, you need to do that for your own personal finances. Never mind just buying a house just for the rates that you're going to get on future car loans or anything in your financial future. Like, start working on your credit as soon as you identify it as a problem, whether you don't have it or it's too low. And one of the main ways to do it is through the secured credit card, because eventually that secured credit card becomes a regular credit card, and that regular credit card becomes a car loan. And then next thing you know, years go by and you have this robust credit profile. Nice use of robust, and
excellent use of robots.
Great use of robust. And next thing you know, you have this robust credit profile, and qualifying for a mortgage is no big deal, but it has to start someplace. And I think that's a great place to start.
Quick story about Haley. Haley had that accident. We were cash people. We bought her a vehicle, and of course, when her vehicle was totaled, Dad, I want a better vehicle. Mm-hmm. And man, she had no credit. Yep. And it actually almost hit me. I'm like, Chris, you've been lecturing people for 20 years about how to do secured credit cards, how to start from the ground floor to get yourself into a great credit profile, and you didn't even do it with your daughter.
Yep.
So guess what I had to do? I had to co-sign a car loan. She ended up getting herself a secured credit card, and now here we are almost a year later, and she was able to remove Dad. But yeah,
it's great advice for people in Haley's age range, a couple of years out of high school and college, not even thinking about buying a home, but that's a great time to start with the secured credit card and start building your credit profile.
Yep.
So, last thing. Get this question all the time. Hey, Chris, do you guys do bridge loans?
The answer is yes, we do, Randy.
It wasn't always that way, but we do have access to a bridge loan. Do you want to dig into it just a little bit?
Yeah, depending on your loan size, we go up to 75% of your present home's value. So, whatever that number is, we will give you up to that figure. We'll pay off your mortgage that you have now.
Yep.
The difference up to 75% of your home's value is then used as the down payment towards your new mortgage.
Yep.
So, you have no payments for 12 months.
So you buy your next house and it's paid off.
Exactly. So,
Yeah.
we give you 12 months to get that process done. It's pretty nice option.
It is. You obviously have to have a bunch of equity in your home, enough to limit the loan to value ratio to 75%, and then still use that difference as the down payment on your next home. But for the borrower that has good equity, this is what people have been asking us for the past couple of years, and we just never had access to it. It does exist. This helps the people that own a home with a bunch of equity but don't want to put themselves in the position where they have to sell to buy and line that up and all the timing and the stress that is involved in that. You do the bridge loan now, you get that difference, you sit on it till you find the right place, and then you don't have to worry about the contingency anymore because you have the money already.
So bridge loans, non-QM loans, QM loans, construction loans, VA loans, FHA loans, RD loans, MSHA loans. I mean, what don't we have?
We got it, man. So there's a lot of ways that we can help people. And the idea of the podcast is just to kind of spend 20, 30, 40 minutes on a monthly basis sharing some of those things. So hopefully this is helpful to people. Anything you want to add, Beds? I have one thing that I want to mention, but go ahead.
Before we leave, you're probably listening to this. You're not watching the version of this that he puts on YouTube. Randy's beard is like a solid 10 today.
It's got a little out of control, but I appreciate that. I'll take it.
A little gray in there. You got some ginger going.
A lot of gray, but getting old, man. But yeah, thanks for pointing that out. Maybe people will shift to the video version to get the full effect.
Don't do it.
Don't do it.
Don't do it. I don't want you liking Randy more than me.
So last thing I want to mention.
Okay.
Me, you, and our guy Larry are sponsoring a CE class with the York County Council of Realtors, doing it with our friends at Atlantic Coast Title. That's going to be on February 4th. And there's two classes. There's one 3-hour class, which is the part 1 in the morning from 9 to 12. And then there's a second one from 1 to 4. And I believe they have room for 95 agents or so. And I think they've already had 82 registrants. So by the time anyone listens to this, if they still make it the full 28 minutes, know that we're sponsoring that, trying to support our realtor partners, get their CE credits, get them out of the way early in 2025 so you don't have to worry about it. But we'll be there hanging out, and that class is on us, so you can go free of cost. So wanted to share that.
Do it.
Yeah. Be fun to see everybody. So, but that's it for me, man. That's all I got.
Thanks for listening, as always, everyone.
I appreciate your support, guys. Have a good month. Let us know if you need anything.